This is Business Incorporated with me, Bosin Amafaya, here at Channel's global headquarters in Lagos. Coming up within the half hour, UK's PZ Couzons says quarterly earnings on track despite pressure on sales volume and prices from the Nigerian market. In South Africa's Capitec Bank sees profit jumps 20% and is worth waiting for. Nigeria's Fidelity Bank posts 31% profit jump at half-year 2018. Let's get down to the details of these and other headline-grabbing business stories at this time. One of Nigeria's listed Tier 2 lender, Fidelity Bank, today announced its numbers for the first half of 2018. The lender says its net profit jumps about 31%. That's the story we got in from this bank, whose numbers has been delayed in coming. The lender reported an increase in earnings per share to 41 kobo from 31 kobo in the same period of 2017. Fidelity Bank says its net profit tops 11.84 billion naira, much better by 31.1%, or 9.03 billion naira reported in the first 6 months of last year. Gross earnings came in at 88.9 billion naira, showing a 3.6% increase, while headline profit was higher, some 27.3% during the period under review. And we're taking that straight to the African markets, and we're checking in also first with the Nigerian stock market, where you can see now the major bourses on the continent having a very decent Wednesday. The Nigerian Stock Exchange are still holding the 33,000 level by that margin at intraday, but that softens a little bit in the afternoon. South Africa's GSE is about 0.1%. The Egyptian market was much stronger from North Africa, 1.60%. The Kenyan market was down 0.2% on Tuesday. And it's, of course, a very decent Wednesday as well across the Middle Eastern market, what they call the GCC. We track 4 of these markets for you on a daily basis, with the exception of the Saudi Tadawul, or what they call the Saudi Stock Exchange, down by 0.2%. The Abu Dhabi market and the Dubai financial markets were shy of each other by those percentage points you see on your TV screen. The Qatar stock market is about 0.16%, a bit lower than Abu Dhabi and Dubai. So what's the days looking like on Wall Street right now? But we'll get a bit of that a little bit later on. But let's check through with our European markets. We're trading around the flat line, was where we saw it early today. Investors focus on today's US FOMC rate decision. Let's add these to other business and market stories making the headlines with analysis and insights as we bring in Paul Christian Breeze, a DW TV correspondent for Channel Television, live to us now from the Frankfurt Stock Exchange. Good afternoon, Paul. Welcome to the program. Let's hit the ground running. U.S. President Donald Trump has just described OPEC as a reaper. He says at the UN that the cartel is reaping other countries when it comes to oil prices. How has this remark affected the markets this Wednesday?
Yeah, well, Trump remarks didn't get him very much or very far, except of counter remarks from Iran that if he wants oil prices to go down, he should keep out of the Middle East business. Donald Trump does want seemingly the impossible. He does want to cut off Iran off the oil market, keeping others from buying oil there, and at the same time he wants oil prices to go down. But that isn't going to happen until the oil and petrol exporting countries, OPEC and Russia, are going to play his game and ramp up the supply, which they're not going to do, as they said earlier this week. Since then, the oil prices have been at historic highs, 4-year highs. Currently, even after the remarks, the Brent price is above $80. And profiting, of course, from this are energy firms. They're selling this energy, so that's driving their share prices up, and that's resulted in Asian share prices going up today, especially the top gainer in the Hang Seng was PetroChina with a gain of near 5%. So no, very little influence from these remarks.
very little influence. The market pushing that aside. But again, President Trump and his trade war is still in the markets. As a new research report was published today by the European Central Bank, predicting that the U.S. economy could shrink by as much as 2% in the first year of an all-out trade war between Washington and the rest of the world, while China and other economies, perhaps in Europe, could gain. Flesh this up for us, this report, Paul.
Yeah, so not that much surprise if you get in trouble with everyone is going to get in trouble with you and hit you back. That's essentially the bottom line of this model calculation. What is important here to keep in focus, though, is that this ECB model assumes that there is a tariff on all products imported to the U.S. from all countries. So to get a reliable number of these 2%, they had to pin down certain factors, and this is what they did. What it does show us, certainly, is that in a trade war situation like this, prices for consumer goods will go up. Following that, investments are going to, companies are going to hold back investments that they otherwise would have made. This will all affect the job market, as they're going to, as customers are going to pay more, but they're not going to have as high wages. It's all going to come down on the one party that inflicts this trade conflict. And by the way, the U.S. has already been there. In 1930, there was the infamous Smoot-Hawley Tariff Act that was supposed to save just two sectors in agriculture, but ended up putting tariffs on 20,000 different items. And to be fair, it didn't cause the Great Depression, but economists are all fairly certain that it made the Great Depression a lot worse than it would have been otherwise. So yeah, dangerous territory here.
Dangerous territory, a very delicate balancing when you go on war, again, on trade, global trade that is, and you're firing on all fours, as it were. So let's finish this conversation, Paul, in the world of business. Sporting giant Nike has been engulfed in controversy over the past few weeks, engaging the U.S. athlete Colin Kaepernick for his adverts. We're now looking at the numbers. It looks like this is coming home to hurt the sporting giant.
Well, if you look at it, Nike has been playing with fire, and it looks like it has been a success for Nike, actually. It has been reporting that revenue is up, and profit margins are also up by 15% here in this quarter. So this playing with fire of bringing in this controversial athlete who's known for his protests against racism and police brutality in the U.S., and who's infamous for kneeling down at the anthem rather than standing up before games, has hit exactly the target audience that Nike was trying to get, the more rebellious, younger generation. Still, the share price has gone down. That is because investors were disappointed after these great results of these ads that the company didn't adjust its outlook, its guidance. It is still at the same level that it was before. So that's a disappointment, and shareholders weren't too happy about that. The shares have gone down.
Yes, when you play with fire with the sporting world, that's a totally different conversation. Thank you so much, Paul. Let's get together tomorrow and have another